The barbell architecture is a survival mechanism designed for a world where risks do not follow a standard bell curve. Most financial models, such as the CAP-M or Sharpe ratio, assume a Gaussian distribution, where tomorrow statistically resembles yesterday. This framework rejects that assumption, recognizing that fat-tailed events, catastrophic once-in-a-generation shocks, occur far more frequently than conventional models predict. The strategic objective is to maintain two opposing missions in tension, protecting the compounding base with extreme aggression while positioning a small fraction of capital into convex payoffs. This is achieved through a structural rejection of the moderate risk middle ground, which includes investment-grade corporate bonds and the classic 60-40 portfolio. Instead, the canonical allocation places 85 to 90% of capital into near-zero default risk instruments and the remaining 10 to 15% into high-risk asymmetric positions where the maximum loss is bounded to the premium paid, but the upside is theoretically uncapped. This architecture is specifically designed to dominate during two distinct macro regimes. The first is a deep deflationary crisis, like the 2008 global financial crisis, where traditional diversification often vanishes as asset correlations spike to 1.0. In such environments, the safe side of the barbell acts as a liquid air raid shelter. The second regime is the violent Black Swan event, such as the March 2020 crash, where out-of-the-money put options can return several thousand%. While this structure deliberately underperforms during secular bull markets, where the cost of option premiums acts as a persistent insurance drag, it ensures the investor survives to buy the rubble when others are liquidated. The fundamental question is whether that premium is a price worth paying for the right to benefit from chaos.
The mechanical components of the barbell must satisfy specific constraints to ensure the system's integrity. The compounding engine, the safe side, is a triple-layered suspension system designed to handle various stress scenarios. Short-duration Treasury bills provide a liquidity buffer and floating yields that track Federal Reserve policy. Layered on top are 7 to 10-year Treasury notes, which provide capital appreciation during deflationary shocks when interest rates collapse. Finally, Treasury inflation-protected securities and gold serve as the failsafe against currency debasement and systemic breakdown. This stack is sized so that even if the speculative side fails entirely, the portfolio's maximum loss is strictly bounded to the predetermined premium spent. On the speculative side, the investor utilizes instruments with explicit convex payoff structures, such as deep out-of-the-money options or early-stage venture capital. Sizing discipline here is paramount. The objective is to maintain a small exposure that can generate 30-to-1 returns during a crisis, effectively funding decades of premium bleed. This structural design directly addresses the failure of traditional correlation math. In a liquidity crisis, the historical negative correlation between equities and bonds often breaks, as seen in 2008 and 2022. During these periods, corporate credit often liquidates alongside equities, leaving the safe middle of a 60-40 portfolio exposed. The barbell responds architecturally. The T-bill sleeve remains unaffected by credit spreads, while the TIPS allocation neutralizes inflationary rate hikes. This protection mechanism is independent of inter-asset correlation, which is the core architectural advantage. By separating extreme safety from extreme speculation, the investor avoids the moderate risk zone where the most dangerous unseen risks typically reside. Summary: the barbell replaces fragile correlations with a robust layered defense and asymmetric upside.
3 mathematical vulnerabilities. First is the premium bleed. Purchasing deep out-of-the-money puts creates a persistent drag of 0.5 to 1.5% annually. The strategy must be sized so that safe-side yields cover this cost, turning speculative bets into yield-financed options. Second is volatility skew pricing. Insurance is often most expensive when fear is high. Protection must be bought systematically during calm markets, not reactively during crises. Third is the sequence of returns. The strategy requires a long time horizon to ensure a Black Swan event eventually justifies the accumulated costs. Governance is maintained through a mechanical rebalancing algorithm triggered by threshold drift. when the speculative side falls below 8% or rises above 20%, or by a major payoff event. Gains must be harvested back into the safe base to prevent the portfolio from drifting into a purely speculative vehicle. From a tax perspective, placing speculative options inside tax-advantaged accounts like IRAs is critical to prevent short-term capital gains from eroding returns. Ultimately, the barbell investor accepts lower returns during bull markets as the explicit price for removing the catastrophic left tail of the distribution. For a high net worth individual near retirement, a 50% drawdown is an existential threat. For them, the insurance premium is a rational expense to protect a lifetime of compounding. However, for a young accumulator with decades to recover from a crash, the cost of the barbell is likely too high. The architecture is not a universal solution, but a precision instrument for those who prioritize absolute survival and the ability to capitalize on systemic instability over market-matching performance. By removing the risk of ruin, the investor secures the geometric mean of long-term wealth.